Ferenc has 10 years of experience working in banking on a large IT project for a major US company. He was an early adopter of Bloodhound and has been designing and building systems for customers since basically the beginning. Apart from running Remek, he is also a visiting lecturer at the Central European University, where he teaches trading strategy design in the Masters of Finance and Masters in Business Analytics programs. With that, Ferenc, feel free to unmute your microphone and we can get started.
Thank you, Keith, and it's a pleasure to be here. Let me just start sharing my screen. Welcome everyone to this session and to Shark Week 2022. It's my great pleasure to be here, and I'd like to check with you quickly if you can see my screen. Let me just look at this.
I can see your screen, and I just wanted to mention, Ferenc, we didn't talk about it, but yeah, bring that chat and the Q&A windows up whenever you're ready to answer questions.
Yes, thank you. Okay, wonderful. So I have all these little boxes ready, and we're ready to go. So welcome everyone to this year's Remek presentation as part of Shark Week 2022. It's my great pleasure to be here. And today I'd like to take you on a journey of discovery and maybe a new way of thinking that I think is crucial in trading. And for many traders, it was the path to success, towards success. So I hope you find this somewhat valuable today, and it will also inspire you to think further and see what's the best way for you to turn your trading business into a success, which it deserves to be. So with that said, I'd like to start talking a little bit about how to think about risk and opportunity in trading, which is a little different than probably in normal life. And many things are different in trading than in normal life. And I'm sure we have all experienced the treacherous path along that road. So the agenda today quickly, first of all, I have these $2 coins there just to show you that risk and opportunity, the way I think they should be thought about in trading is just as two sides of the same coin. There's no risk without opportunity. There's no opportunity without risk. Risk is not a dirty word in any way. Risk is something that we welcome because that's the one that brings us the opportunities. So risk is here to be managed, to be assumed, taken on, and making sure in such a way that it has an edge, but more about that later. So let's see what we're going to talk about. In last year's presentation, if you go back to Shark Indicator's YouTube channel, you might find it there. I touched upon a couple of basic facts or foundational truths or topics in trading that I'd like to just go through quickly in 2-3 minutes. Again, if I may, that would be the start of this presentation. Then we'd be talking a little bit about risk in more specific terms and how to turn risk into opportunity, which is what we want to do. And last, I will show you a couple of products that we have designed that could help you to make it all happen. And then, of course, like every year, we'll have a little special coupon code for you in appreciation of your attendance and also of all the efforts that we traders put into this business on the markets. So let's start. One more thing I'd like to say, I usually don't put so many words on the slide. I'm not a big fan of that. But in this case, I thought maybe I'll make just a little bit of exception, not much, just a little bit, because this is being recorded. So later on, you'll be able to refer back to this. And if I mention or if I don't mention something that's on the slide, you can stop the tape or the video and spend a little time thinking about these. But I think these are the major points that I'd like to convey today. So let's jump right in. So first of all, the first thing that each of us we have to decide why are we doing this? Is this a business or in some form, maybe even justified form, if I have the money to blow, whatever, it's just entertainment. And I think these 4 questions, if we ask ourselves, and when I say we or you, I always include myself because I'm just a trader, just like each of us here. So this goes for all of us, and that includes me as well. So we have to ask 4 questions, and we have to have these check marks. Otherwise, this is not going to work as a business. It could work as entertainment, but that's not the topic of today's conversation or presentation. So first of all, we need a written plan. Not everybody has it. I'm not saying that it's impossible to be successful without a written plan, but it makes life so much easier to crystallize our ideas and put it on paper or electronic form, whatever, and update it regularly. Markets change, conditions change, markets regime change. We all remember 2011 and previous years, the big bull market on the indexes. Now, since last November, we're struggling because it seems to be over. So things change, and the business plan must be a living document that guides our behavior, governs our behavior on the markets. And that's something that we always have to adhere to. All right. And then the next question is probably could be strange to some of us. It was for me first, which is that I can't be worried about my next trade. If I'm worried about my next trade, then I didn't do the math. It's so simple. I cannot be worried about the outcome of my next trade. So this check mark is definitely something that's a strong indication that this is being run as a business. Also, we're going to look at this in detail in a little Excel chart a little later, that I simply must know that when I trade my strategy, what's the maximum expected number of losers in a row? If I don't know that number, obviously I don't know what risk I'm running, and it's like driving an airplane with my eyes closed. So it could work, but probably it will not. So we're going to talk a little bit about later, and I'm just trying to move my mouse here, so just to show you what I'm talking about here. And the other one is a psychological side of it, that I must be comfortable with that fact. So if I did my calculation and my Excel chart says sooner or later, if I do this long enough, I'm going to have 7 losers in a row. It's just a matter of time. I must be comfortable with that eventuality. If I'm not, then there is something wrong with the math, and we'll get to that later. And closely related to that, I cannot risk more of my account at any given time. If I have 1 trade on the market or 5 trades on the market at any given time, what matters is the accumulative risk that I'm taking at any moment. That must be a statistically safe amount of my account, of my capital. Otherwise, I'm going into the territory of gambling, which we do not want to do. So I hope you will agree to this, or at least give serious thought about these points. And maybe there's a 5th one, I don't know, possible, but these came to my mind as the most important ones. Also, if you don't have the 4 check marks here, you're probably trading, your trading is probably not a business. That's just the hard, cold truth of this all. So moving on, the next thing I'd like to highlight again, this has come up in the past. You might find this chart in other videos, but I just wanted to highlight this one more time quickly. And this is another foundational truth in the market. Understanding this, I think, for me anyway, it was the key. It was probably the one, if I just want to name one single event or realization at 3 a.m. in the morning, after, of course, reading 1,000 books about it and stuff, is summed up in this chart. So I would encourage you to spend a little time here, go through these little comments, but I'm going to give you a quick summary right here. So basically what happens in the market is it's a probabilistic game. It's a probabilistic series of events. We could call it game, doesn't matter. It's a probabilistic series of events. On the market, we need price to move for even the chance to make profit, because we are technically motivated directional traders. All right, so what moves price? What moves price is the imbalance between basically buyers and sellers, or their motivation. There are imbalances in the market that will move price. Price will find a new balance for a while, and then something will happen and it will move again. So that's how it works. Okay, so we need imbalance. The problem is, so far so good. We welcome imbalances. But the problem is that when you look at the chart, or you could look at a data series, the tape or dome or whatever, the imbalances do not show. They certainly do not show on the chart. The imbalances would be this green circle. I just market. So this green circle is the imbalances in the market, and we need them and we welcome them, and they come to us. The problem is that you can't see the imbalances directly. What you can see, and what I see, and what all of us see, is of course charts, or the movement of price on the chart. And what we can do is that we can analyze the movement of price on the charts, and we can discover or recognize patterns, repeating patterns, and we try to find patterns that could have or offer some profits for us. That's what we want to do. Okay, that's fine. So there will be patterns on the chart, but I'd like to point out one fact here. And if I may, I just want to jump on our website for 1 second. On our website, interestingly, this is the most visited page on our website. Let me show it to you. This page is called The Edge. It's not even linked, so it's hard to find. But nonetheless, if I go to Google, whatever, analytics, this is the most visited page. And I'm so happy about it because it's crucial. Now, the point here is that this is a totally random chart. This is a random chart generator. And what happens is that if I press F5 or refresh, reload the chart, there will be a new chart. And the interesting thing about this is that all the patterns, the pullbacks, the head and shoulders, or whatever you want to look for, support, resistance, they will all be here. You will find them all on a random chart. So what does that tell us? That tells us that a random process is quite capable of generating the patterns that we're looking for. Now, what does that mean? That means that when you see a pattern on the chart, let's say, I just see a pullback because that's what I'm into mostly. So let's say I see a pullback, beautiful pullback on the chart. There is no way of knowing if this is a result of a random data event, data series, in which case there's no edge in there, or an actual imbalance of the market, in which case I'm very interested in trading it because that's where my profits will come from. There's no way of knowing. So please, if you worry about entering a trade, this is the first thing that you can think about. There's no reason to blame yourself if it's a loser because nobody knows the outcome of the trade. The only thing you have to worry about is following your plan. If you didn't follow your plan, you don't deserve the beer. But if you followed the plan and it turned out to be a loser, who cares? And I'm saying who cares, assuming that we have done the math, and we're going to get to that. So as long as you've done the math, the outcome of the next trade is impossible to predict. It's not even important for us. We don't have to know to be successful. And that's a great relief psychologically. I stopped worrying when I worked a long time on working myself to teach myself to accept that fact. So I encourage you to give it a little thought and also the notes on this chart. All right, so give me a second because I just want to make sure I didn't forget to mention anything. Right, and then I want to say something about the yellow area, which is, of course, the shared area between the patterns and the actual imbalances. So as you can see, this is just tries to show that there will be patterns on the chart which actually are a result of imbalances. Those are shown in yellow. And there will be patterns on the chart which are just randomly there and they come and go. And we might enter those trades, and we will enter those as well. And we have a high likelihood of those trades not being winners, but we have no way of knowing which one is which one. Our purpose, of course, is to trade as much of the yellow area as possible. So trade and find and identify patterns which most likely are a result of a market imbalance. So enough said about this chart, but I leave it here, and I will be in the recording, so you can come back to this and spend a couple of minutes thinking about this. It will really push me forward when I just stop blaming myself for a loser. All right. The next thing that there's no escaping is that trading is a business of statistics. Luckily, not too difficult. Nothing really, I mean, high school math is much more difficult than what we're going to do here. And this is the little notation of the edge. No need to be scared of this. It's just that the average, the percentage of our winners multiplied by the average win plus the percentage of our losers multiplied by the average loss must be bigger than 0. Otherwise, mathematically, we're not going to make money. This is the edge. And as we know from Jack Schwager in this famous book, check it out if you haven't yet. If you don't know what your edge is, then you don't have one. And that's another very ruthless truth that we cannot ignore in the job that we do. All right, so 2 scenarios. If you don't have an edge, that includes me. So if we don't have an edge, we have no reason to be on the market because we will lose our money sooner or faster or slower, whatever. It's a mathematical necessity. Think of it this way. We're gonna, let's say we're gonna start flipping coins. And flipping coins is, if it's a fair coin, it's 50-50. And I'm gonna say, okay, well, let's play a game. If it's heads, I give you $1. If it's tails, you give me $1. And you would tell me, well, come on, man, this is a total waste of time. There's no edge here. Nobody's going to win. So it's a total waste of time. And you're right. However, if I change the game's rules, for example, like this, it's still 50-50. We're going to flip coins. But if it's heads, I give you 120. If it's tails, you give me $1. You would say, oh, I'd love to play that game forever. And you would be right, because that's what an edge is. What we want is to find an edge in the market. There are edges, not big, but they are there. And we have to identify them and teach ourselves to execute them. And that's how we can be successful in the markets. Otherwise, in this game of I give you 120, you give me $1, we're going to flip coin. Me losing is a mathematical necessity. It's just a matter of time by the time I lose all my money. So that's how the edge works. And the first exercise for each of us here is to make sure that we do have an edge. And I refer back to Jack Schwager. If we don't know what our edge is, if we can't say it in 2 minutes, explain it to a 10-year-old kid, then we don't have one. All right, now let's look at, so we're done with that part. So now we're going to assume that we have an edge, or we are working on identifying our edge. All right, so if we have an edge, then we have to do some simple math, because having an edge is not enough. We have to make sure that, you see, the edge manifests itself over a large number of trades, of events. Like flipping a coin. Flipping it 3 times will not tell me anything. Flipping it 1,000 times will tell me if it's a fair coin or not a fair coin, perhaps. So any edge will come to surface over a large number of trades. Now, it comes from this fact that we have to stay in the game in order to manifest our edge. You just have to stay in the game. Our first goal is to stay in the game, which means that we have to define how much money we can safely risk within this confines of maximum expected losing streaks, which are an Excel chart will help us to figure out what that is. So there's 2 numbers we need to know. What is the maximum number of losers I must be ready to accept and expect in a row? And second, how much money can I risk at any time so that that fat tail event will not blow me out? You see, fat tail events do happen more frequently than we would like to think on the markets, because returns are not normally distributed, but I don't want to get too technical here, but so they will happen. They will happen. And we know they're coming, and they will be coming. They will hit our account. We must be able to withstand that hit when that comes without even a blink. Well, ideally, but of course, it's easier said than done. But that's the point. So 2 things: the maximum number of losers, right? That's the one number I need to know. And second, I need to find a way to figure out if that's the maximum number, okay, then how much can I risk on any one trade so that if this happens, I'm not blown out. Okay, so let's move on. So we're talking about trading as a business. The next thing I'd like to, and this is also part of the journey have the privilege of taking you on today, is to challenge you to think a little differently about risk. And just imagine that we run a flower shop, or that we're a taxi driver, or a friend of mine runs a restaurant. Okay, well, that friend, 2 p.m., 7 p.m., the restaurant opens, 2 p.m., he goes to the market and buys the stuff. but he's not sweating about it. That's not really a risk for his restaurant. That's not something that he looks at as a risk. He looks at it as inventory. Same thing for a taxi driver. Is buying gas a risk? No, it's part of the business. It's overhead. Same thing for a flower shop. 4 a.m., I go out to the wholesale market. I buy my flowers. 10 a.m., I'll sell it to other people. Okay, I don't fret about 4 a.m. I fret about other things. So you have to start thinking of your losing trade as an overhead, as a cost of doing business, and an expected and pre-calculated cost of doing business, just like for the taxi driver and for the other guys who are business people as well. So we are here trying to think as a business person. That's the only way it's going to work. So, all right. So a losing trade, I know it doesn't happen from 1 minute to the other, but if you work on it a little bit, spend a little time thinking about this and just train yourself to try to accept the fact that there's nothing to worry about a losing trade as long as you have done the math, very important. And as long as you have followed your business plan, your trading plan. All right, so a losing trade will become, after this transition or transformation of thinking, becomes like your data feed, or like, I don't know, buying NT8 or buying a product that you need for your trading. And it shouldn't even, cause emotions in your head, right? Why would I get emotional about CQG? I mean, I won't. It's just my data feed or my internet connection for that matter. So this is how I think starting to think about the losing trade, your next upcoming losing trade like this, takes a big burden upon your shoulders so you can devote your energies on more productive stuff. And let's get into that more productive stuff. But before that, of course, this is just a quick list. I wrote this in 5 minutes. You can think of other risks, probably 100 more. These are just the thing, but I think it's important to kind of list them in your head or even write them down. So as a business, we have business risks and we have outside risks or market risks we don't really have a control over, but we need to find a way to manage them nonetheless. Maybe I'll just use the annotation tool to better be able to show you where I'm trying to spotlight. Does that help? Yeah, maybe my cursor is a little better. So business risks. All right. Well, certainly lack of a written plan preferably is a big risk. The biggest risk is not having an edge. And there are some everyday risks, which will happen sooner or later. Just 2 weeks ago, I had no power for half a day. So loss of electricity. Imagine you're in a trade and you can't get to the chart. Like in the old days, we need to have the phone numbers ready right above the monitor. There needs to be a disaster recovery plan. What are the events which I don't want to have them to happen, but they will happen sooner or later, one way or the other. I need to be able to handle them and not try to improvise when it happens. So you need to have the phone numbers. You need to have a contingency plan for all of these possible events. But these events, if you notice, they're just events like a flower shop or a taxi driver. Mostly, it's just a business risk, which can be thought of and ways can be found, of course, to mitigate them. All right, now there's market risks. This is more related to trading itself. But if you note, a losing trade will not be on this list. Again, assuming that we have done the math. So correlation. The people who trade with me on Remek Premium, they know how we trade currencies and major pairs. So if I go short on the 6E, like maybe we're going to do it right now, or 6B or 6A, I'm not going to pile up risk in the same direction because I know that there's correlation. That's all just trades against the US dollar strength, let's say. Fat tail events. We tend to dismiss potential events, which are very, very, very unlikely to happen. But listen to this. When they happen, they can blow us out. Now, those are the danger points. You have to think about fat tail events, and you have to know what you're going to do when they happen. And you have to make sure that when they happen, or if they happen, rather when they happen, they will not blow our accounts out. Also, gaps. It's easy to think I used to think that way. That, of course, I put a stop on the market and then either intraday or overnight, whatever. And I get to the screen half an hour later. And if I'm stopped out, I'm stopped out. Well, yes, but I could show you ZW, for example. You remember this maybe 2 months ago, ZW, there was a lock limit on ZW wheat market because it gapped up several times in a row. So imagine gap up means, and lock limit too, means that you have the stop sitting on the chart, but it didn't get hit. Price jumped over your stop and you're still in the trade and you're down 2, 3, 4 R's, and R's, we'll talk about that later if you want also, but gaps is an important risk that we have to think about, and they will happen. Even on liquid markets. I'm not saying it's too often, but there was another one on Swiss franc, by the way. So on liquid currencies, it can happen as well. Very, very important to be mindful of that. Lock limits too. Just go back to the ZW chart, maybe a month ago it was. Okay, regulatory requirements. That could be anything. We're trading the United States, the US markets. So if something changes in the law or whatever financial regulations, we need to be aware of that. They do change sometimes. Not every change is really significant, but we need to be aware of that. And also, more importantly, probably that this happens much more often during the year, that our broker or the market itself, CME, changes the margin requirement. That could happen. I entered the trade when, I don't know, margin was like, I'm just saying a number, 5,000 on the Swiss franc. I wake up the next morning, margin is 10,000, and I need to put money on my account. What am I going to do if I don't have that money? So these are all risks, fat tail events that must be thought about. And so I hope you're starting to see that a losing trade is the least of our problems here, really, especially if we have done, and only if we have done, the math. All right, so let's move on. And I'm just looking at my chat box here. If you have any questions or you want to challenge me in anything, please feel free and type away in the chat box or in the Q&A. And I'll try to look at this every couple of minutes. So I see if you have questions, just type them in here and feel free to stop me. Okay, so let's move on quickly. So this is another important question that I came to along the road of trader development, I should say. Okay, so if trading success starts when, or if the road to trading success starts when I don't look at a losing trade as a risk anymore, then what must be done so that it is not seen as a risk anymore? And the answer is right here. We have to do some math. And again, luckily, the math is not too complicated. And we have some very handy calculators. Let me just jump on the website a little. Let me just see down here. We have a page called calculators. And there's a couple of calculators, well, 6 or 7, that I built them for myself. They were a big help for me. And please do check them out and see how they can help you and how they can help you develop this kind of thinking that we're talking about today. So it's remek.ca/calculators. So back to the point. Before we crunch the numbers, there is one fundamental hurdle that we as human beings, we must be aware of. And this goes back to maybe, well, thousands or tens of thousands of years. There's nothing we can do about it because this is how we are built. So how are we built? And why is trading such a big challenge? If I want to be a surgeon, I go to university. I'm not saying it's easy, but I can go to school and they teach me how to do it. If I want to be a pilot, okay, it's not easy, but I just have to pass the exams and I'll do it. Even learn the piano to some level, or tennis, or any skills. It's possible. Trading, most of us find that trading is a different animal. Trading is very, very hard. Why? Because unlike the other professions, trading is not like the life out there that we used to, and nothing works the way it works or we are used to doing in life. Now, what are those things? Okay, let me just try to sum this up. This is, these are two cavemen, right? Like maybe whatever, the old us, whatever, X number of years ago, hundreds of thousands of years ago. And the bush rustles, is that the English words? I'm not sure. Keith, you will tell me what's the right word. So there's some noise coming from the bush. And one guy says, it's a tiger, and starts to run like hell. The other guy says, well, let's look at the data. This guy here, he's the Isaac Newton of the day. He's the genius. The other guy is dumb, but he's the one who's going to run without thinking. This guy starts running the math or the stats and say, well, I've been sitting here, we've been sitting here for 20 years every day, and we have seen 2 tigers over 20 years, but we have seen 10,000 birds or whatever else. So I'm going to stay and finish my dinner. And of course, he can get lucky once or twice or 3 times, but the day will come when it will turn out to be a tiger, and chances are he will not pass on his genes. So we are descendants of this guy who ran. And jokingly, I say like an idiot, without thinking. And this is the guy, Newton, but he never had children. So we are not built to think in probabilities. We are built to think in fight or flight reflexes. And that's very useful in life. We are here. This guy is not here. We are here. We are the one who survived. But the problem is, on the market, we have to be like this guy. We have to run the stats. If we behave like this guy, and probably you have experienced the same thing many, many times, or years and years, I've been struggling with, I said, how come every day I just do exactly the wrong thing? I always do exactly what I shouldn't be doing. And maybe you have that feeling, you have had that feeling too, because we are human. So long story short, this fundamental hurdle, the ability to start thinking in probabilities, is a skill that takes time to develop. It goes against our nature. We're not very good at that. And but we do have to conquer this big challenge. And yes, this is right. This is the most important slide, if there is one in this presentation. This is the biggest challenge. It's not the next losing trade. And this is the key to start looking at risk the proper way. All right, so let's move on then. And then after all this theory, let's look at this Excel chart, which I'd like to spend a minute on. It's on our website. And it's called Systemetrics Calculator. You can find it easy. And let's suppose that you have run your back testing, you have data, maybe even forward testing in simulation. You should actually, and you have data, and you have thousands and thousands of trades, your own trades in the database, simulated trades nonetheless, but still data that now you want to see if it's viable to even start thinking about going live. And this chart helps you enter some data from your database. If you export it from NinjaTrader, this will be easily available for you. So in this little example, let me just show you something. So here we have, let's suppose that we have put on many, many trades, and 55% of our trades are winners, and our average win, I'm just using round numbers to make it easy. The math part, let's say our average win is $100, and the same with the loss. And as you can see, we have an edge here because we have more winners than losers. And also, although the reward risk ratio is 1-to-1, I will have a positive number here. The expectancy will be positive because it's a mathematical necessity, because there's an edge built in or baked in to this equation. So let's suppose I just want to put on one contract for now, maybe 100 tick stop, whatever, just to use a round number. As you can see, I'm trading the micro ES 125 a tick. So I'm risking $125 per trade. And this is an important metrics. How many % of my account do I want to risk at any one time? And you can say 2% is ridiculously low because you would rather risk 20%. Can I enter 20 here? Interestingly, I can't enter a number. Maybe my database is not working. Sorry about that. I can't enter, for some reason, the number here. I'm not sure why. But so let's just work with 2. And then let's say I put on 1 trade a day. You can change this later. It doesn't matter. All right. So now you can see that this Excel chart automatically calculates the expectancy. As we know, the expectancy must be a positive number. It is positive, so we're good. All right. And here is where things become interesting. Here's where we're getting to risk. There is a formula behind this cell. I'm not going to go into. This is a probabilistic formula. You can look it up, Google it. It's not a secret, but so it's built into this cell. This cell automatically calculates the maximum number of losing trades in a row. In this case, it's 9. Notice that if I change the data, oh, for some reason, I don't know, I think I made that file read-only. I'm so sorry I can't do this right now. But believe me when I say this, if I change the data in the yellow field, this number would change. It will change. It updates itself automatically. Sorry about this. I have to fix this after the presentation. So if you get to this later, I'll make sure it works. So right now, just let's work with these numbers, which are the default numbers. So if I trade this system, I have a very solid edge, very, very solid edge, but I still, sooner or later, I'm going to be hit by 9 losers. 9 losers. I mean, that's even for a pro trader, that's a situation that must be dealt with in a cool fashion and as unemotional as possible. Now, if you just multiply the numbers here, it's a micro ES, so that 9 losers would be more than $1,000 down as a maximum expected drawdowns, and then it will calculate for you the recommended account size to trade this strategy if you ever wanted to trade this strategy. This is actually coming from, just imagining, this is coming from your testing. So let's suppose this is your trading system right now with these data. Good. And it tells you how much money do you need to start. So far, so good. Again, if you change the numbers in the yellow fields, I'm going to make sure that this whole thing is automatically updates itself. So whatever you enter here, these numbers will be calculated for you. And please be mindful of what you're getting here, the maximum number of losing trades in a row. That's important. And how much money you will need to trade the system without running a large danger of getting blown out or blowing the account. Okay, so let's get to the next part. The next part is a 6-month capital accumulation plan. It is theoretical, I admit. It's not real life, of course. Real life is always different. But as every model, theoretical model, we need a model to describe reality and to start working with reality and to start making a plan. So this part here is a 6-month capital accumulation plan. It assumes that, which will not be true because we are human, that we never make a mistake, that we always follow our trading plan to the letter, and that we don't fall asleep on the chair and stuff like that. Okay, but so let's see what we're getting here. So we're starting the first month, we're starting with this data. The gray area comes from the data up here, so we don't have to worry about that. After, you see, we're starting with 62.50. After a month of trading this in a disciplined manner, this system, we're going to end up with, statistically speaking, of course, 64.50. So we made a little money. The question is, I'm trading one contract. Can I start trading 2 contracts? Well, I enter 2 here. I'm getting a red number, and the red is a warning sign. You're risking too much. You're risking too much. You're running the risk of blowing your account. This number ideally should be not more than 3 anyway. Usually 1 to 2.5, something like that, but not 3, not 4% anyway. So what can we do? We're going to, oh, it's not working. I need to change this to 1, and then this number would stop being red. And all the same game with the other months. So this, if you enter the contract size that you would like to trade that month, if this number is red, reduce this contract size. So for some reason it's not working now, my apologies. I'm going to fix it later, but this is the idea. So again, just to repeat, you enter your contract size. Maybe I want to trade 5 contracts because I'm such a smart guy. Okay, but then this number will be red. It's a red flag. You're risking too much. The next fat tail event will take you out of business, and you don't want that. So reduce the number of contracts traded. This will lead to a 6-month period. If done diligently, you may end up with a bigger account. So again, sorry about this little hiccup here. I can't change the number for some reason. I'll look into that. And let's continue. What else we have here today? And now basically, right. So I do want to mention that we've been working hard for 10 years to design and produce products which are designed to help you in this challenging journey. And one type of product that we have is a full-blown trading system, as it were, is a trading office. We saved it as a workspace in Ninja, and this is what you see. This is the whole office. There are some important parts of this, which the people who are with me on Remek or who are our customers, they know exactly. This part here, highlighted by this red arrow, is the Market Scanner Pro, which quantitatively, in a objective fashion, calculates values for us and potentially colored messages that will guide us to trade the right way, the right market at the right time in the right way. Other parts of the system, this is our other pride of joy, Remek Converter, which has the unique ability to convert risk into dollars. Risk into dollars, and not based on the tick side. A common misunderstanding, for example, let me just mention this. Let's say the NASDAQ, the NQ is $5 a tick. The ES is $12.50 a tick. And I used to think this for years and years. Well, it's more risky to trade the ES because the tick size is bigger. Well, it's not like that at all. Not necessarily like that at all. Actually, if you think about it, or if you have tried, I think you will agree with me, it's much more risky to trade the NQ. Why? Because you have to think of this like I don't know, I will have this crazy image of, let's say, two monkeys on a trampoline. One is a smaller monkey, and that is a larger monkey. Let's say the smaller monkey is the NQ because that's only $5 a tick. The other one is a $12.50, the ES. Yes, but so far so good. But then I find is that the smaller monkey tends to jump much bigger, and the larger monkey just jumps smaller distances. So tick size is not really a good, not the best, is not a bad one, but not the best way to measure risk. We have to think in either standard deviation or ATRs, and more about, they can find a lot of stuff on the website about that. So I'm not going to go into that today, but it's much better to measure risk in ATRs. And this indicator that we have here called Remek Converter, actually, it's part of this indicator pack, does just that. It translates proper risk measured in ATRs into dollars. Okay, and of course, the big product, our pride and joy, is the Remek Momentum Pro, which has a Bloodhound Blackbird version. You can see Bloodhound here and Blackbird. So we always make sure it's compatible with the latest Bloodhound and Blackbird releases. So you're good to go going forward. As 2.0 will come out, we'll adapt to it. And you're most welcome to trade this system on your Bloodhound Ninja platform because it's compatible. You can see the stripes here. And so basically, that's what I wanted to share with you quickly. And let me just see if there's anything I missed. And I also want to clear up these things. Right. So if we think about this, what would I think are the key takeaways for today is, first and foremost, understanding, like, think of the flower shop or the restaurant or the flower or the taxi driver, whatever. Think of what is the actual risk in your trading, and be comfortable with the fact that if you have done the homework, then the next losing trade is a pre-calculated overhead in your annual trading business. And this is nothing really worry about. Of course, you will have to worry about if things get out of hand and you stop following your plan. That's a problem. That's an emotional, psychological discipline problem, but it's not a mathematical problem. If you have done the math, then a losing trade should not be seen as a risk anymore. That's a big step towards success. And then we have to think about how to manage the risks that are real risks. And we have a list. We had a list of that in one of those slides, and probably you can put more on the list. But again, just note, a losing trade will not be on that list, not on the market risk side and not on the business risk side, because it's pre-calculated overhead like paying for electricity. And probably the biggest challenge for any trader is that we need to learn to think in probabilities. That's a skill. That's probably, I don't want to use big words, but it's even like a new way of seeing the world. Certainly true within our trading business. I'm not saying it goes for every area of life, maybe not, but within our business, we have to think in probabilities the proper way, and we have to make sure that those things which are quite unlikely but disastrous cannot happen to us, or if they happen, we have a way of managing them. That's how that's all that it comes down to. All right, so I'd like to thank you for your participation in this quick run through. And my job will be now to fix that Excel chart when we're done. But thank you for listening and for your attention. And let me know if you have any questions, and feel free to disagree. I know this might be challenging. It was challenging for me for years, but once I got through this hurdle, I sleep better, and hopefully based on the numbers anyway, I trade better, and probably the people on premium, Remek premium, can say, agree or disagree with me on that. So I'll leave it up to them. And last but not least, before we get to the specials, of course, I do want to show you the product itself in NinjaTrader, because we have Ninja running here. And look, this is our Remek Momentum Pro. I'm going to close this trading system. The arrows is a little bigger because my resolution, the screen resolution on this screen is a little different than on my laptop, but you can, of course, customize this in any way. And as you can see, here is the Market Scanner Pro inside NinjaTrader's Market Analyzer. That is basically our Houston, our brain. This is what guides us in our behavior as we approach the markets. I can even those who are with me, they already know that I'm missing 2 columns, and I can load the premium template. Look at how easy this is. And there will be 2 other columns, hopefully, here showing up quickly as soon as Ninja agrees with me. But maybe not. Let's see. Okay, so in any case, this is Market Scanner Pro. It is a product in itself, but it's bundled with everything that, or the advanced products that you buy from us. And here is the actual, now Ninja is working. It's a little slower than I thought it would be. And once we have the market analyzer ready with the 2 new columns, I hope to be able to show you how Bloodhound and Blackbird functions on this chart. You can already see our trend indicator, our Bloodhound-based trend indicator on each chart. Then why do we have 5 charts? Because I, as a product designer, I don't know what time frame you want to trade. I don't want to tell you what time frame you want to trade. My job is to offer you fantastic products as good as possible, and then offer you all the possibilities and a certain way of looking at the market that I am convinced leads to success. So therefore, there are several time frames. As you decide about which one to be active on, you can maybe close the time frames that you're not going to use anyway. So this is just a default workspace coming out of the factory. And now I have to update my database, of course, because some of the contracts expired. Here we go. So now at least I'm able to tell you how this works in these little steps in Ninja that probably most of us are quite familiar with. Okay, so now we are going to update these contracts because, as you see from the yellow, this contract expired X number of days ago. So we need to put the current contracts on the chart. So it's coming up. It's all automated. And in the meantime, while it's loading, let me just say one thing about the last column, which is, we call it USD, but what is behind the last column is actually the Remek converter indicator. The Remek converter indicator is an objective tool, is a tool to objectively measure risk. You can see that, relatively speaking, trading HO is almost 7 times more risky at this point than trading the DX, for example. And these numbers do change over time. So just because maybe 2 months down the road, the DX might be 7,000 and this 1,000. So things can change here. But at any time, at any point in time, you get a pretty good idea of what instruments, how they compare in light of, in terms of risks. This is actually the daily time frame, and you're most welcome to change. Let me just show you one more thing. You don't have to set it up the same way I do. The Remek converter runs on a daily time frame. You can put it on a 50-minute chart or an hourly chart, whatever you want. It's all up to you. They are completely customized, as we all know in Ninja. Now, last but not least, let me show you the meat and potatoes. So this is our Remek Momentum Pro Bloodhound system. Here we go. And we have a Blackbird strategy manager we call Remek Momentum Pro, not surprisingly, of course. And let me see, as soon as, here we go, enable the system. And now, you know this process already. We have the algorithm itself is black boxed, so that's proprietary. But the trade management engine, which is in Blackbird, is completely customizable. You can just click on order settings, and I'm sure all of you are, if you're familiar with Blackbird, you know what I'm going to show you here. Here we go. This is the familiar interface in Blackbird, and you're most welcome. This is the factory setting with 3 contracts and certain stop and target values and certain logic to trail the positions, but you're most welcome to design your own, come up with something better or something that fits your situation better than this factory setting. But nonetheless, this is something that you can easily start with. And also, it's a good introduction to learning Blackbird. Blackbird is a fantastic product. And all these little rules that I included with the product, if you just have a closer look and understand the logic, it can really help you and propel you yourself in your own work with Bloodhound and Blackbird to design your own systems or to take or not take any ideas that you might find here. So this is just a sample strategy or trade management rule set in Blackbird that takes care of 3 contracts, one of which is a runner. So you will see that the third contract doesn't have a profit target. That's what we call a runner. There's no profit target. It will run as much as long as until it gets stopped out, in other words. Okay, so we are ready to go. I can enable the system. Right now, I'm on the Australian dollar on a 5-minute chart. And these are my signals. I can switch on to, of course, any other bar type or time frame that you want. And I can also switch to a different instrument. And I'm not going to go into too much detail about all this market scanner because that's not the topic of today's presentation. But you can see the setup signals and sometimes even the trigger signals here and some other data that is important for us. So right now, for example, this is a 4-hour time frame. We have a long setup on the Canadian dollar right now. And this, oh, sorry, I should wait for. This at this point is still interpreted as a bull flag, so a long setup. Probably when we touch the lower Keltner, this long setup will remove itself because the setup is no longer valid. I can show you just another example. Let's look at the Japanese yen and then we can call it a day. So here we go. Again, the 4-hour time frame, which is this chart here. And look at this beautiful bear flag. Oh, I'm sorry, I'm still looking at. I have to wait till the chart updates. Here we go. But this is a short setup here. And why do I have a long setup a couple of bars before? That's an interesting and a valid question. And somebody would have asked me sooner or later anyway. And that is, the reason for that is because the short here, shows the last bar, the current state. This was 3-4 candles ago. And as we know, the arrows, they stay on the chart. So they're sticky. You see, they will stay on the chart from the past. You see the arrows here. So this was a long setup, but now we know from the market analyzer that it has failed. And now we, if anything, then we're looking for a short trade. So, but that's more about the details. That's a topic for another conversation. Quite interesting, but let's leave that for another day. This is the product that I'd like you to know about, and perhaps even consider it for your trading business as a tool on your desktop to be available for you if and when you need it. Again, you will need Bloodhound and Blackbird to run this, but luckily, and let me get back to the chart, to our presentation, maybe the last page, we have some, here we go. Give me a second. We have some specials today in the form of a coupon code, Remek Shark Week 2022. Just enter this coupon on these links for all the products itself and the premium if you're interested. That's a nightly service, but you can check it out on this page. 33% off this week. And that includes, oh, by the way, we have fantastic bundles. So if you're thinking of grabbing a copy of Bloodhound, and let me just show that to you. Bloodhound, I need my bookmarks so I can get to the website easily. So I'm just going to hop on the shop here, and I'm going to highlight the fact that we have in cooperation with Shark Indicators. Now, look at this. So this includes the 33% off. They're marked red because they're already baked in the 33% off. So this means they're bundles of our products and Bloodhound and or Blackbird, and in some cases, even the Renko bars, SIBT Pro. So feel free to look around here, and if something is missing from your arsenal, from your toolbox, Shark Indicator product or Remek product for that matter, then I think this is a good time as any to get a great deal on these bundles. So thank you very much. And I can see some questions here. So let me see what questions. Coral trend with Bollinger Bands. Hi, Rochester. What is your question actually, if I may ask, about coral trends and Bollingers? While I'm waiting for you to type in a more specific question, perhaps, let me see what Bruce wrote. Is working on the site. Oh, wow. Okay, well, that's, first of all, that's good news. But then there is something wrong on my machine. Maybe I'm logged out, or maybe I'm logged in. I think I'm logged in with the wrong username or something, because yeah, on my chart, on my browser, it was read only. But I'm glad to see. So what Bruce is saying, just to show this to everyone, what I was not able to show you for some reason that I'm going to investigate. But if you click on the website, Bruce says that on his browser, in his browser, these fields work. So you just have to enter your data in the yellow fields, and everything else will be automatically calculated for you. So thank you, Bruce, for that. And Rochester, let me see. Let's see live action on charts. Okay, this is live action. The market is open. So I'm trading a 5-minute chart. The 6J may be a little slow, but let me see if there's, is there any market you'd like to look at specifically? It's lunchtime, so I'm not expecting earth-shaking action, not on the indexes anyway. You can look at this list. These are the 20 or so instruments that I follow. If you'd like to look at something, then let me know. Or I'm gonna check out maybe wheat, or any of you guys have any preference to which market you'd like to look at? We are short on wheat, but that's on the daily time frame, but we can look at any market. I'm just gonna stay on the ES right now. And it's a good point, Rochester, thanks. So let's try to see a trade in real time. So I'm gonna probably just switch to a small tick chart, a very small chart, so we can get some triggers here, some signals. And give me a second. Looks like my chart is still updating. Okay, so I'm going to switch on the system. Blackbird is running right now, and 5 minutes is a little slow. Let me, well, maybe, how about, I just want to get a signal right away. So how about a, I don't know, 250 tick on the ES? That's a pretty small. ZB? Okay, Bob, is ZB moving today? Yeah, ZB, we have a doji on the daily. ZB is proverbially slow at times, but anyway, that's fine. So here, just as an example, okay, this is a very, very small chart on the ES. I would not trade this time frame in real life, as far as I'm concerned, but just to get some signals and how the system works under Bloodhound, that's a very good example. So would you like me to tell you of, give you some more details on this system right now? I'm always in the danger of, I can talk half an hour about this, so I'd just like to ask if you want further details on how the system works exactly. Just type in a yes or no. In the meantime, I'm just fiddling with the visual look of the chart. I'm gonna make this line a little thinner so it looks better on the chart. Yes, okay, thank you. Okay, thank you guys. So, all right, so let's imagine that it's, let's imagine I'm an intraday trader. I'm not going to fiddle too much about the time frame. That's every time I change the time frame, we have to wait 30 seconds for my Ninja to update. So let me not do that. But let's say that we have the time frame of our preference, whatever it is. We have our market, or what's the word, contract or instrument of our preference, and then we are trading, and we're trading the Bloodhound compatible product. You can see that we have short signals and long signals, blue and red. Those are automatically calculated for you, and they are exactly, most of the time. I can change something. Give me a second. I'm going to change something, and then they will be exactly the same position as the Bloodhound stripes. The only thing I need to change is to put this to composite. That's a little detail. Some of you guys will know what I'm doing, but if you don't, that's okay. Don't worry. It's a little detail. So right now, I'm just, I have just ensured that the settings of the indicator match the settings of our Bloodhound product. And that will result, mathematically, no other way to do this, no other possibility. My stripes, Bloodhound stripes, and the Remek signals will be in the same position. You see, when there's an arrow, there's a stripe. Beautiful. Okay, so now we are trading, and as you can see, we are now short. I'm sorry, we are long, of course. We are long with 3 contracts, and I haven't checked my Blackbird algorithm before I put the trade on. So probably there's a reason why this is a little closer. I'm not sure if price has moved or maybe a setting is not correct, but if I jump on my Blackbird, I could check. But the point of the matter is that we are in a trade, and our trade is automatically managed with these settings. So we have a target 2 ATRs away. We always measure everything in ATRs when there's a way. That's how we do it. That's what I think is the best way to use in trading as much as possible. So target defined in ATRs, 1 target open, that's the runner. And then initial stop, 2 kinds of stops, of course, initial stop and then the trade management stop, which can move and does move, and based on these rules. And just a little bit of detail, if you're really into Blackbird, you will notice that this only has 3 rules. That's the first contract. That's 2 ATRs away. When the first contract is hit 2 ATRs away, then from that point on, we only have 2 contracts left. The second contract will have new rules. two new rules which did not exist for this contract, but this contract, when these new rules come into effect, that contract had already been hit, so it's not on the market anymore. And then you see that the third contract still has new rules, because when the third contract, the runner is being managed, hopefully, is after our second contract at 4 ATRs is taken out. So you can see that we have 3 rules, 5 rules, and even more, 8 rules. You don't have to do it this way. You can keep it more simple, but we included this with the factory settings so that just to inspire people to just to play around with the product, because Blackbird is fantastic. So feel free to play around. You can simplify this. You can remove rules if you want, but these rules, the bottom line is that these rules will manage your trade, your position in an objective fashion based on your rules. Now, what's fantastic about Blackbird is that I design my rules on Saturday afternoon over a good coffee, on the patio, whatever, when I'm relaxed, when I'm in the right mindset, I'm not under stress. That's when I design my rules and I save them. And come Monday, I get on the market, I enter a trade, I don't change my rules. In the heat of the moment, when I'm compromised, when I'm not logical, when I'm emotional, I'm liable as a human being, and I'm liable to screwing it up, basically. So that way, I ensure that the rules which I mathematically validated that work when I was objective, those are the rules I'm going to use when I'm actually entering the battle. So this is how it works. Again, it doesn't have to be on a small chart. I just got into this chart to get a signal quickly, and we did. We are long, for better or worse. And of course, nobody ever is going to take all the signals, whatever the time frame. Nobody's going to take all the signals. You have to be a little discretionary. You have to do a little thinking. So as far as I'm concerned, I do have a trading plan, and my trading plan says, and your trading plan could be different, is that whatever is my trading time frame, I always want to go in the direction of a higher time frame trend. So I'm just going to try to, maybe will not be the case right now, because of course we just entered the trade randomly, but the idea would be that, let's say this is a higher time frame, this is a lower time frame, and let's say my rule is that I only consider a long entry if the higher time frame is also in an uptrend. That's when I want to join this uptrend. You can even say that I'm actually trading this trend, but I'm fine-tuning my entry on the lower chart. Whichever way you want to phrase your words, the result is the same. You're entering on one time frame at the best possible moment, which is calculated for you by the algorithm objectively. It's math, doesn't make a mistake, doesn't get tired. And the point is that I only want to trade, as far as I'm concerned, you can do it differently if you want, but I only trade in the expected direction of the higher time frame, and in which case we have a complex bull flag, so I'm expecting a move to the upside. Let's say that this could be my way of thinking if I really was trading this, but in this situation, this is just an example. And please ask me questions, because I tend to talk about, when it comes to Blackbird, I can go on for a week. So any particular questions about this? You can display this in monetary figures or percentage or points. And again, it's a great product, and it allows us to, by having the brain here, it's just my style of trading that I follow 20 or so instruments. But if you just specialize in one instrument or maybe two, that's perfectly all right, perfectly all right. Actually, for many people, that's one ingredient of their success, specialization. But for me, I do automate things, but if you notice from my talk here, is that I do pick what I think are the best entries. So look at these short trades. This is kind of an area where the market flattens out. So if you let's suppose this is, again, I would never trade this time frame, but let's suppose, look, this is a big drop, little flattening. Now this is completely horizontal. Do we really want to go short here? Well, it could work, but the real the real meat and potato was here. When we go to, when it comes to trends, everybody knows that, pullback number 2 or 3 or maybe 4 is usually more powerful or more usable for us than pullback number 27, because trends tend to transition into something else. So there will be a range-bound market coming sooner or later after a trend, usually. So I do a little thinking, but the point is, the way I do it, there's many ways to use Bloodhound and Blackbird, of course. There's not one right way to use it. Our algorithm itself is rock solid on any time frame. So this will tell you what we call this is, technically speaking, is identifies the reemergence of momentum out of consolidation areas. Consolidation area is just a fancy word for pullback, but it's a better word because consolidation areas can be horizontal. Not every pullback is sloping, of course. There are horizontal consolidation areas, and we don't care if it's sloping or not. What we want is consolidation. And our indicator, our algorithm, rather, which shows, of course, as an arrow, an indicator, correctly, mathematically, in an unavoidable, necessary manner, tirelessly and objectively, will identify the reemergence of momentum when price moves out of this bull flag. Now, of course, why am I not talking to you from my private island? Well, because trading is a probabilistic game. There are probably many reasons, but the most important, what is relevant for us here, is that, of course, when I enter a reemergence of momentum, at the time I enter it, I don't know the future. And the fact is, you can do your own research and you might find it differently from what I found, but by and large, roughly speaking, 1/3 of the trades will hit my 1R, my target. Another third will kind of move sideways, which I'm not very exciting to be in. And another third will flatly break down and I'll get stopped out. So you have to devise, this is just rough numbers, but by and large, it could be true. And our job is to devise such a trading engine or a trading system that can force an edge out of this. And it can be. So, but again, when I enter the trade, if it's a loser, I couldn't care less. I'm not saying I'm happy about it, but okay, so what? I have rules for maximum daily loss and stuff, like each of us. We have rules to govern our behavior and not to get carried away by in the spur of the moment. That's a no-no. Other than that, I'm completely comfortable with the fact that when I enter the trade, I have no idea what will happen, which is how it is. Nobody knows. And we have to, we know that. Nothing new there. All right. So thank you very much. I'll stop here. It's been more than an hour. I really appreciate your attendance and your attention. And sorry if we went into maybe a little bit more details, but be mindful of these excellent specials. This is a good time to grab the deals if you're into Bloodhound and Blackbird, definitely the bundles. And you don't need to buy our products, by the way. Bloodhound and Blackbird are also available, of course, just by themselves. Here we go. So no need to buy anything from us. They're all here. And feel free to browse around. We have great material, hopefully, on the website and other services, which you're welcome to explore. In the meantime, look at this beautiful example. I got lucky here, guys, because this trade actually works. So it gives me an opportunity not to brag because the entry was random. So, but to demonstrate the trailing stop, you see the second contract has been hit, and now we are, no, actually, yes, we are running. This is now the runner, no target sitting up here, and we are trailing it. And our trailing stop right now is within our entry, which means that in the worst case, we're going to make some money. In a better case, we're going to make more money. So this is now trailing our position from behind, and we are within our entry. So this happens to be luckily, a good example to demonstrate what we do. But listen, even if this had been a losing trade, it's the same thing. We didn't know it in advance, but the system's job is to handle whatever comes at us, whatever the market throws at us, and whether it's a loser or winner, a well-designed Blackbird algorithm can do a fantastic job. And I would also highly recommend that you use our algorithmic signal, which drives Bloodhound and Blackbird. You see the stripes come from our algorithm. So again, thank you so much. I'll stop right here and let me know if you have any questions or anything that I forgot to mention. And I'll just put on the last page of our presentation here. So just in case you want to jot down the coupon code or anything, here we go.